Welcome to the Compounders Podcast, where we explore the anatomy of public company wealth creation stories. On this show, we invite you to be a fly on the wall for the actual conversations professional investors have with public company CEOs. I'm your host, Ben Claremont, a partner and portfolio manager at Cove Street Capital. In these conversations, I interview senior executives by posing the exact questions I ask as part of Cove Street's diligence process. Whether you are a professional investor, founder, or someone who is simply interested in business, we think this podcast has something for you. This season of Compounders, the Anatomy of a Multibagger, is sponsored by Tegas. Tegas is an innovative and disruptive company that is changing the way professional investors work. For more information, please visit their site at tegas.co.
All opinions expressed by your hosts and the podcast guests are solely their own opinion and do not reflect the opinion of Cove Street Capital or any affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The hosts and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable.
My guest on the show today is Alan McKim, the founder, chairman, and CEO of Clean Harbors. Clean Harbors is a $5.6 billion market cap company that provides environmental and industrial services within North America. The company has two segments: environmental services and Safety-Kleen sustainable solutions. In the environmental segment, Clean Harbors collects, treats, and disposes of waste within its company-owned landfills and incinerators. In addition, the Safety-Kleen division provides cleaning and waste disposal services to customers such as automotive repair shops. In fact, Clean Harbors is the largest recycler of used motor oil in North America. Alan McKim founded the company in 1980 and took it public at $9 in 1987. Over that period of time, Clean Harbors has made a number of large acquisitions, including the transformational merger with Safety-Kleen in 2012. The company now produces over $3 billion in revenue, and its stock has risen to over $100 per share. It is not often that I have a chance to talk to someone who has run a company for 40 years, so I really enjoyed speaking with Alan about the following topics: the uniqueness of Clean Harbors' asset base and how that creates a moat, how the company decides to take big swings when it comes to M&A, educating people about how Clean Harbors is a good actor in a world increasingly focused on ESG, the impact of further environmental regulations on the company, and building a cohesive culture over 40 years. Before we begin, just a few disclosures to note. First, Cove Street owns Clean Harbors shares, but most importantly, all the music in this podcast was created and composed by Cove Street's own Jeff Bronchick. And without any further ado, here's my conversation with Clean Harbors Chairman and CEO, Alan McKim. As always, we will start this podcast at a critical moment in the company's history. So let's go back to the fall of 2012. You've just announced the deal to acquire Safety-Kleen for $1.25 billion. This was by far the largest acquisition the company had ever undertaken and was going to really diversify the revenue stream of the company. I would love to hear why you thought Safety-Kleen was the right company to take such a large swing at, and what you saw as a primary benefit of bringing on that asset.
Sure. So, Ben, I think it's important to look back even 10 years prior to. So when you look at 2002, Clean Harbors acquired Safety-Kleen's environmental services business called the Chemical Services Division. And we bought that business out of bankruptcy. At the time, that business had both the Safety-Kleen environmental business and the Chemical Services Division. And so our initial interest was in the Chemical Services Division. It gave us a tremendous amount of assets, 3,500 employees. And the majority of the disposal assets that we have today are the result of that acquisition in 2002. Safety-Kleen Environmental continued on under private equity ownership, and we continued to have ongoing business relationship with them because at one time they were one company, and we knew them very well. They were a big customer of ours. They generated a lot of waste, over $200 million of waste a year. And as the private equity company looked at ways of monetizing, they decided whether they're going to go public or maybe sell it to another PE firm or a strategic like us. And we really felt like it was the right time for us to acquire that business, knowing it so well for so many years. Really gave us a foothold into the small quantity generator business because it gave us over 200 branch locations in North America, which were, smaller branch business, 300,000 customers, going after different vertical markets than we historically had. And it really helped drive more waste into our disposal facilities.
So it's interesting. Sorry, I was just going to say, it's interesting to say that you were so familiar with that asset. Did that allow you to hit the ground running culturally and in terms of integrating the businesses? Or would you say it took a little while for you to figure out how to put these two businesses together?
I think we really understood the business well. We knew a lot of the people there. We had done business with them together. And we had a lot of former Safety-Kleen employees working for us because, again, we took on 3,500 people when we did the first acquisition of Safety-Kleen Chemical Services Division. I would say that the first year, which was 2013, we closed in December of 2012. That first year was a really difficult year. What we saw was a significant decline in the value of the recycled products that Safety-Kleen was creating. And being a waste oil collection business, we also had a significant waste oil collection business, but Safety-Kleen had unique assets that were allowing to re-refine oil and sell those products. And the value of those products significantly became under pressure. Even though price of crude oil was relatively stable, the value of the oil really came under pressure. And it really forced us to take out a lot more cost, really go at the synergies a lot faster. And I would say that in the first year or two, it was a tough going for us. But I think as we look back here today, it's a wonderful acquisition, and we continue to build off of that infrastructure and that footprint that we got.
Yeah, I would agree that it really feels like in the last few years, when COVID kind of notwithstanding, it feels like you guys are like the combined companies are really hitting on all cylinders. And so, but given how much the investing world is focused on ESG and companies that are considered to be the good guys when it comes to the environmental side, the fact that Safety-Kleen collects and then recycles substances like used oil, that would suggest that, Safety-Kleen was really, really well positioned for the world that exists today. Was that a major aspect, kind of the environmental aspect? Was that a major aspect of the original acquisition, or is that more of just it's a benefit that's kind of accrued over time where you've seen like the ESG positives associated with owning the Safety-Kleen asset?
Well, I think two things. We clearly the closed loop that Safety-Kleen had. First, remember that they had a large install base of parts washer machines out there at automotive and industrial sites. And so a big part of that closed loop was taking that solvent, bringing it back to their recycling facilities, re-refining it, and then giving it back to the customers again over and over and over again. So that first recycling aspect of Safety-Kleen dates back 60 years. But oil, number one player in recycling of oil. We also had a huge chemical recycling business. We've seen that the shift where companies are looking to have more and more recycling as an alternative to disposal. And so more and more of the waste that we collect, we're the largest hazardous waste collector in North America. So more of what we collect is being recycled. And then ultimately we have the end disposal sites to handle the residues, but it was absolutely right in our sweet spot for going after those assets.
And I'm sorry if this is a little of a tangent, and this may be an old wives' tale, but is it really true that in some states used motor oil is not considered a hazardous substance and people can basically put it down the drain? Is that an accurate statement?
Yeah, it's certainly possible. There are many states that waste oil is exempt from the RCRA hazardous waste rules. States like New Jersey, Massachusetts, California, it's a hazardous waste and it's taxed as a hazardous waste. But there are other states that don't treat it so. But I would say that the days of putting it down the drain are probably long gone. I think that companies realize that this is a valuable product. there's a value to recycling and reusing this material, and they want to be a good steward to the environment as well.
Got it. And one thing that I'm always interested in that I think a lot of investors don't ask about is, the importance of brands and whether or not you should, when you make an acquisition, you should maintain a brand, or you should go from turn everything into Clean Harbors. But it's interesting, since you have such a long history of owning Safety-Kleen branded assets, why, what's the value of keeping that Safety-Kleen name as opposed to saying everything in this company's Clean Harbors?
It's a great question. We've debated it many times, and Safety-Kleen, as I mentioned, a 60-year-old company with a wonderful reputation in the automotive industry, and it has a big presence in NASCAR. Their products, the types of services that they offer, those big yellow trucks that they've run for years and years have, real strong name recognition in the market. And so we really have thought about consolidating them together, but I think we've recognized that for the customer base that we're servicing under the Safety-Kleen business and for the types of services that we offer, it really does make sense to continue to build on that strong brand that they have both in the US and Canada.
Got it. That makes a lot of sense. So moving to, from the initial Safety-Kleen deal to more of the present, in a strange symmetry, I don't know if you even recognize this, but the HydroChem deal that you just announced was for the exact same amount, 1.25 billion. I thought that was kind of funny. But so it appears that you guys think that this is the time to take another big swing. So why HydroChem, and then why is this the right time, do you think, in the company's evolution to be adding another $1 billion plus acquisition?
Sure. Well, we certainly love being number one in the markets that we're servicing. We're the number one player in used motor oil, number one parts washer service company, number one hazardous waste management company. Up until now, we've really been sort of the number three player in the industrial area. We have a strong presence in Canada and in the US. I think we really feel that the scale will really be important for us as we think about what customers are looking for. They're looking for suppliers that can handle multiple plants. They're really trying to consolidate suppliers. They're also looking for suppliers that can bring technology to differentiate, sort of the ways that they've been handling the maintenance at their plants. And HydroChem has invested heavily in R&D and developing these hands-free technologies, which really goes well into our whole safety culture here. We have an R&D group down in LaPorte, Texas, but it hasn't anywhere near advanced as the HydroChem team that's been in business a lot longer than we have in the industrial space. Safety is really what we're all about. And if we can go out and perform a service on a customer site with less people, with more technology, hands-free technology particularly, that's going to make us safer, and the customer is going to see, a lower cost. And I think those are the things that we see as combining our capabilities together on the industrial side. And they don't provide any disposal to their customer base. So we've got these wonderful disposal assets that are nearby their service locations. And we see this as another great opportunity to do more recycling, particularly the oils that get collected as part of the industrial cleaning, and really, really take our recycling into their customer base.
Definitely. That makes sense as well. And you mentioned that when you first bought Safety-Kleen, the first 2 years were a little bit of a tough go. Anything that you learned from integrating that Safety-Kleen deal, the second one, and that will help you, I think, will help you with the HydroChem integration?
We've done about 65 acquisitions in our history here, and we've learned through those acquisitions that it's really important for us to get them on our platform day one or as close to day one as possible. We're not a company where we like to run multiple ERP systems and run consolidation, on financials and what have you. We want to put people right on our platform. If they have something unique, some proprietary system that enables them to to function maybe a little bit more efficiently, we'll certainly look at that. But, we have built out sort of a proprietary platform to run our entire business. All 50 lines of business, $3.5 billion of revenue. Our whole quote to invoice system is all done on our proprietary system. And so by getting the acquisition day one on our platform, we really get control of the business. We're able to get our synergies as quickly as possible because it's really important for us to get the costs out of the business, quickly, but also to leverage, basically the capabilities of our technology, whether it be, the Salesforce technology that we have, which is, cloud-based CRM, and really tying in the sales organization together, on that one common platform. Those are some of the things that I think we've learned over the years. It's really important for us to do.
And now a quick word about our sponsor. Before we started using the Tegas platform in 2017, CoStreet rarely used expert networks to find high-value sources to help us better understand the companies we follow. The competitors' offerings were expensive and limited. Tegas changed that dynamic through their innovative business model, allowing firms like ours with a more limited research budget to conduct expert calls at a fraction of the price of others. Tegas then records, transcribes, anonymizes, and posts a transcript to their platform for subscribers to learn from. Every new Tegas customer makes the platform stronger through deeper and richer transcripts, and I've personally seen the growth over the past 4 years. The Tegas network of experts and platform of previous calls has made the service an indispensable part of our investment process. In fact, we now use the word Tegas as a verb. If you haven't tried Tegas before, I highly recommend going to tegas.co for a free trial and to start Tegasing your research. So as you mentioned, you've done a lot of acquisitions over your tenure. I'm interested. So obviously getting something on the ERP early seems like something that you've really settled on. Any other ways in which your strategy, either regarding the strategic rationale for acquisitions or the way you integrate them, anything else changed over, all the deals that you've done?
You certainly learn. Every time you do a deal, it's going to be different. And sometimes you learn, and sometimes you learn the hard way. With Safety-Kleen Environmental, they had SAP as their general ledger and some of their financial systems, for example. And we let that stay up for 3 or 4 years to handle their inventory and supply chain. And we just should have put it off and done it right away and shut it down, and we didn't. And I would say that that's a good example where we just held on too long with some technology that came with the deal that we shouldn't have taken. Again, I'll go back to, sort of, we have a playbook. We have a very good leadership team here on how to do the integration. Typically, we have about 35 different teams that, encompass hundreds of people that come from both the acquired company and our company. And we really work together to make sure that we've got the right structure, put the right players on the field. I think we've learned long ago that you got to put the right person in the job. It doesn't have to be the Clean Harbors person or the HydroChem person. Who's the right person is going to now take on this much bigger role, for example, in running a region or running a sales force. So I think, that whole commercial side of business has been really important for us to really focus on.
We've talked a lot about Safety-Kleen so far, but I want to move over to the environmental services side. So when I think about the moat around this company, I think of the fact that you own 9 of the 13 non-captive incinerators in North America. And from my knowledge, no one has built a new incinerator in North America since Clean Harbors built the one in El Dorado, Arkansas. So that seems like a pretty sturdy moat. For people who are not familiar with the incineration world, why is it so hard to get these facilities approved and to build them?
Certainly you have the not in my backyard syndrome. When you look at where our incinerators are located, they're very much in remote areas for the most part. Outside of Deer Park, which is right in the Houston Ship Channel area, almost all of our assets in 600, 1,200 acre plots that are in very remote areas. We tried back in the late 80s to site an incinerator at one of our plants here in the Northeast, and it just became a lightning rod for opposition. So I think because of that history, I think people realized that to go through the greenfield permitting is almost impossible. And so it's much better for us to take an existing site like Kimball and say, hey, we've got a great relationship with the community. We've got a big footprint there. Let's think about putting a second unit in to that particular location. So that's been our approach on how to expand our incineration.
So you mentioned the brownfield expansion at Kimball, which is in Nebraska. It just seems like, as you said, this is always such a risky thing where, the community can push back, and these things take a long time to build and to test. So why is that a good use of shareholder capital rather than spending on M&A or other organic growth opportunities? Like why is that Kimball expansion, I think, is the right time for that?
What we've seen over the past 20 years is over 100 captives that were operating back in the day have slowly but surely shut down. Many of these companies that run their own incinerators have either decided that they don't want to continue to be in the incineration business and invest the capital, or because of mergers or divestitures or acquisitions that have taken place in their industry or their business, those facilities became antiquated. And so whether you look at a Kodak up in Rochester, New York, or a GE in Waterford, New York, you have these captives, and over a period of time, we're now down to about 50 of them. And we continue to see more customers interested in outsourcing more of their waste, which is similar to what you saw with the 3M announcement, where 3M has got an incinerator. It's only 20 years old, but they've decided that they want to partner with us in outsourcing that material. So at least our vision is that more of those captives are going to close, more is going to be outsourced. And we also think that more manufacturing is going to be coming onshore. I think the disruptions that we've seen as a result of COVID and the disruption in supply chain, I believe, and I think other people would agree, that more chemical manufacturing and general manufacturing is going to come back to the States. And with that is going to be more generation of waste. The low price of natural gas has certainly spurred the development of more chemical plants in the Gulf, in Pennsylvania even. And so that cheap natural gas is really going to help drive more industry to set up shop here and generate more waste. And we want to be prepared to service those customers.
That makes sense. So one thing I've always liked about this company is that you've proven over and over again that you're willing to take some short-term margin pain in exchange for long-term gains. But I'm interested how you've been able to get the organization to be okay with making a longer-term investment, whether it was in El Dorado or in Kimball, where these things take a long time to play out. Like, how do you get people comfortable with investments like that don't have an immediate payoff?
I think the company's really focused on return on invested capital. We're really focused on free cash flow. There are certainly 4 components of the use of cash, whether we're buying back stock or we're doing acquisitions or we're paying down debt or making big capital investments. And I think we look at all 4 of those regularly to try to make sure, are we, doing the right thing for our shareholders? And as you know, debt is so cheap today, and we've got such a great rating for both Moody's and S&P. So we can borrow money relatively cheaply and compared to issuing equity. And I think we've just said, let's look at all these things. And I think the incineration investment has proven, particularly with the El Dorado plant that we built, that these really become a home run for the company. It might take 3 or 4 years to build it and $150 million or so in investment, but we see nothing but upside, to be honest with you.
One of my favorite investors likes to invest with companies who have, quote unquote, the willingness to suffer. And it sounds like this company has that. And I mean, in the sense that like there's short-term pain for long-term gain. But I always like to ask management teams and CEOs about, are there areas where you wish you had been willing to suffer more or had put more money in maybe 5 or 10 years ago that you think would have paid off handsomely years later?
That's a good question. I'm not sure if I guess what I would say is I wish we didn't suffer as much in some of the acquisitions we've made. As you know, we got involved in the oil and gas side of the business. We saw the shale revolution coming. We saw the opportunity not only in the U.S. but Canada, and we made the Eveready acquisition in 2009, which really gave us a strong footprint in Alberta, and particularly up in the oil sands, as well as in the Gulf of Mexico. And with that came a number of different types of businesses, quite frankly, that are not synergistic with our service offering. And so I think we probably could have divested them faster. We went through a real bad downturn in 2014 when the price of crude oil really went down. And so I think in that case, we suffered longer than we wish that we had with that investment that we made.
Before we leave the incinerator side, you guys had a little trouble with El Dorado when it first started up. And I think that's pretty common in the industry, where it just like takes a little while to get these facilities really going. But have you learned anything about building that facility that can make the Kimball expansion less costly and maybe even more ready to start running the second it's completed?
I think we're going to be able to build it faster. I think it's going to be a little bit more expensive only because of all of the inflationary cost increases that you've been hearing about. That plant was the first plant built in over 20 years, and we had to meet the new MAC 2 standards. That's the air pollution control standards needed to meet the most current air regulations. And I would say that some of the back-end air pollution control technologies, particularly our spray dryer technology, we had a number of issues. We actually had a disagreement with our contractor on that. And I would say that took us an extra year to work through so that we met the requirements of our air pollution control systems, but also was allowed to run the plant, from a rateability standpoint. And so we did learn significantly around that whole spray dryer issue. I would say that we'll certainly take those learnings into this new plant, and our expectation is that the plant will come online faster and without sort of those difficulties that we learned from.
You mentioned regulation, so I'd love to talk a little bit about that. I think it's always important for shareholders to remember that regulators are important stakeholders for all companies. But in the case of Clean Harbors, you're handling such messy waste and that you're regulated by a number of entities. What is your general approach to creating a win-win relationship with your regulatory stakeholders?
Yeah, as you can imagine, we're heavily regulated. We have over 450 permitted facilities and permits that we abide by. And so it's so critical that we manage our operations appropriately. But also our customers also have to abide by those same permits. And so those same type of permits, those same type of regulators. So it's what drives the demand for our services, but it's also what we have to make sure that we're abiding by. I would say that our approach has been that we only can get better when a regulator comes into our facility and not only are they doing an inspection, but they're bringing their knowledge about what's happening in other plants and other locations. And, how do we learn from them? How do we look at what they're focused on, and how do we kind of make that best practice so that we can improve in our safety and our compliance? So, the legacy that I want to leave behind here is one of safety. I want people to say, hey, Clean Harbors was the company that was so successful because it was the safest company. Its employees operated safely, and it really was a company that really focused on compliance.
So going on that theme a little bit, This company has periodically received some minor fines from various regulators. I think that happens across the space. But how do you use those situations as learning moments that helps the company get better? Like how do you communicate with people? How do you, if someone violated something, like how do you deal with those people in a way that, allows them to get better as opposed to, feeling shamed or like they don't belong anymore?
Sure. Well, I chair the safety committee here at the company, and I can tell you that we look at every single notice of violation or any financial penalties. And what we have tried to do is build out the systems and processes so that we can do a better job of inspecting our facilities, whether it be leak detection and repair, whether it be just the simple inspections or the monitoring that needs to take place. And I think also working with the regulators. If we do receive a financial penalty, because a lot of the regulators are incentivized, certainly to find something, that's their job, right? They want to come in, they want to find something, they want to educate us on what they see that we could do to improve. And so what we've tried to do is develop methodologies here that really emulate what they do. And so when a regulator comes into our plants, our compliance people have already been operating like them coming into our plants, and so you're still going to get opportunities for a regulator to find something that they can write us up. But it's just that continuous learning that we want to make sure to improve in how we run our company.
I think some people think of the term regulation and they think regulation is a negative for companies. But for Clean Harbors, the more the EPA and other bodies crack down on chemicals and other forms of waste, the bigger the opportunity. I'm interested in how you position the company to benefit from changing regulations. Do you have to try to look around the corner and acquire technologies? Do you have to try to anticipate where regulators are going to go? Or, you've been doing this for 40 years and, that's just part of the DNA is to kind of move with the tide.
I think we certainly try to have an influence. We recently, worked with some of the congressional leaders to help get a bill passed that the Department of Energy ultimately did a study around waste oil and the use of waste oil. And from that study came out 18 different recommendations, almost all of it around trying to get more reuse of our recycled oils, to try to get more of these oils away from being burnt as a fuel or being used as a waste oil heater, fuel supply, but really trying to figure out how to take this become more of a green product. And I think that's where I think we can help, sort of shape some of these regulations and participate in these different industry groups, whether it's the Hazardous Waste Treatment Council or some of the other groups out there. So we are trying to be, a leader in that. But we also recognize that, the regulations are a two-edged sword, right? I mean, they're good because it drives more business for us, but we also have to make sure that we're staying on our toes.
That makes sense as a strategy. Thanks for sharing that. So jumping around a little bit, getting to the route network that you operate. So I'm generally a big fan of route businesses because if you have a dense network, it's not too hard to add new customers to the route, and that in itself can reduce the cost of collection. So is it crazy for me to think that the oil collection and parts washing businesses that have these distinct routes, there's a moat around them due to that network? Is that a fair assessment?
It really is. This is a subscription business, much different than the legacy Clean Harbors business. So when you think about Safety-Kleen, 40,000 orders a week are generated automatically because of those subscriptions that are set up. And all of those routes are automatically routed through dynamic background optimizers to figure out what's the most efficient way for us to handle those routes. And then the ability to add to those routes. How do we sell into those routes? How do we figure out a way to get more route density inside those routes? is really all part of, the success that we've seen since owning the Safety-Kleen business.
I think there's some perception out there that, especially the some of your customers who do oil changes and brake jobs and stuff like that, like those businesses will be impacted as the world moves to more electric vehicles. I'd love to hear how you think about that, both threat and opportunity. As maybe we're just producing less used motor oil as the world becomes more electrified. How do you think about that?
I think at least for the next 10 years, we don't think it's going to be material. As maybe adoption becomes more significant, that may lower the volume of lube oil that is demanded. But when you think about where oil is being used today, it's industrial oil, it's in off-site, off-street oil, like the big yellow iron that you have out there, boats and marine, and there's so many different places where lubricating oil today is being used and generated, and it's not all going to go away. And today, over 1 billion gallons of used motor oil is generated just in the States, and only about 500 million of that is re-refined. And so we know that more oil can be re-refined, and we know that the market is growing. But at some point, if the electric vehicle market really takes off and the electrification across, the United States happens, which is, a big investment that would be needed, maybe the demand for lube oil down the road will not be as great as it is today.
Yeah, it sounds like there's some puts and takes there. Another thing that I'm curious about is the closed loop, which we haven't, you mentioned a little bit, but the idea that you could collect the used motor oil, re-refine it, and then sell it back to your customers as opposed to them buying, a virgin motor oil. I mean, you've had that business for a while. It just feels like, I would assume in the world today, that would be an incredibly compelling offering for your customers from an ESG perspective. So why do you think there's been slow uptake there? And do you think that some of the things that we're seeing in the world today may catalyze more adoption of the closed loop?
Yeah, I think we're going to see further acceleration in the growth in that side of our business. This year, in the beginning of this year, we broke out our bulk products and services business from the SK environmental business. And I think one of the things we realized is that, we just had a lot of different things to sell and under one sales force, under one service delivery. And we really needed more focus. And so breaking out our used motor oil collection and our lube oil delivery, essentially the closed loop side of our business, we felt that with that focus, we'll be able to do a better job of, number one, managing the spread, and number two, growing our direct lube oil business. We also realized that we probably knew a much better job of marketing and promoting that whole green closed loop aspect. And I think you'll see more and more of us generating more excitement around that side of our business.
That the closed loop is just another one, I think, of your really interesting assets, and in some of which I would call almost irreplaceable. And so, as one of the things that's always perplexed me about Clean Harbors, and this is an issue that persists today, is that this company, despite those assets and the stock, seem to trade at a discount to some of the other waste management peers. I don't know how much you guys think about that, but I'd be interested to hear if you had any sense for why that is, like what might people be maybe underappreciating about your assets relative to, someone like a Waste Management, for example.
Yeah, I think it's a great question. It's a frustration that we have when we see the multiples that they enjoy. They enjoy much higher EBITDA margins. They have a much simpler business, as you can imagine. I think maybe owning 250 landfills and a number of transfer facilities and a whole bunch of collection trucks, and really be kind of singular focused on that with a much larger market between residential and industrial. And so I think, they've done a wonderful job of driving costs out of those businesses, whether it's for public or waste. And I think they've been rewarded handsomely, for that. And I think that, again, that repetitive nature, that subscription side of their business, I think they really get rewarded for that and a much higher multiple than we do. I think to some extent it might be the nature of our business where, we do a lot of emergency response work. We do a lot of project work. We do have certainly $1 billion of what I would say, repetitive generating kind of waste that are coming out of manufacturing, day in and day out. But some of our revenues are project and not subscription based. And I think we probably get a little penalized because of that. What do you want to call lack of visibility or predictability there? I also think that we have, from a cash flow standpoint, though, I look at the amount of CapEx that, some of these companies have to spend. And I look at what we've done. And, I think our ROIC, is coming up on double digits here pretty soon. I think we're running a really good business here. And I hope at some point we can continue to see an expansion of our multiple.
And the foundation, I think, of any good business is the people. So I'd love to spend a little more time on that. So you founded this company back in 1980, more than 40 years ago. Over that time, what have you learned about building a sustainable and cohesive culture within a company that has so many assets and so many people running around? I mean, it sounds like safety is kind of the core of that, but I'd love to hear, from giving just incredible perspective on this, like how you've thought and maybe how your views have evolved on creating and building cultures.
Yeah, it's a wonderful question because, through acquisitions and through growth, how do you keep that culture alive and how do you make sure that you have a consistent culture across all the business that you do? It is always a work in process in my mind. It is about communications. It's about, getting your leadership team regularly together. It's about creating sort of that vision and understanding of what kind of company are we? How do we run our business? What are our core values? Kind of laying, sort of that mission out there that everybody can get behind, because we do great things. You have to be a unique person and want to work for our company. The bell rings, we're running out the door. Right now we're dealing with Hurricane Ida. We're down there and we're going to mobilize everything and anything that our customers need, as well as our own staff needs. And that takes a unique kind of individual to want to, be in this kind of business. And I think we've just been so fortunate to have not only a great group of employees, but a great group of leaders who have stayed with the business, have grown with the company. And now when you look at the depth of leadership here, it's really the best of the best in the industry. And I'm really proud of that. And I'm just proud to be working here with them because I think they're terrific.
And in terms of retaining and hiring and compensating people, I would love to hear what you've learned over your career about the best ways to do those things. Because my guess is what you thought about, like the right way to compensate people when you first started this business and motivate people, has changed a fair amount. And you talk about the depth of leadership. How have you learned to, maintain and retain those kind of people within the organization?
In some cases, we haven't been able to retain everybody we want. And I'm happy to say, though, that we've seen 13 employees leave here and become CEOs of other, environmental companies. And sometimes that's great because that plants a seed that hopefully we can go and maybe do business with them in the future or acquire them in the future. But at the same token, we've realized that, sometimes people want to leave because there's no room for them to move up. And I think one of the nice things about our company is because we've grown from $600,000 in 1980 to, where we are today, there's been tremendous opportunity for people to learn new skills, to develop themselves inside the company, for us to help educate them, and promote them. And I think because of that, that has really created a fabric inside the company that is really, really strong.
You mentioned the idea that 13 people left to go be CEOs of another company because, you were kind of sitting in that CEO seat. So I'm wondering how you thought about succession planning, and, you have really huge shoes to fill as the founder. Like how have you thought about that? And, when, what would be the sign to you that like, we have the right person to hand the torch over to?
Yeah, so we, succession planning is critical for us here, and it's something that the board and I meet on every board meeting, every quarter, and we talk about succession planning from at the board level, to make sure that we're bringing in new new board members, diverse board members. We're also talking about at my level, both on the short term and long term. And also, sort of thinking through all of my direct reports in this succession planning. And I think, part of my job is to make sure that we have a plan in place that the board and corporate governance committee of the board is bought into. And I think both on the short term and long term, I think we have a good plan in place. I continue to, love doing what I'm doing. I'm still actively involved in leading the company, and I think when the time comes for me to leave, I feel very confident that we have a good plan in place, to keep this company getting to $5 billion and beyond.
You mentioned your interactions with the board, and I can imagine in those interactions, you have a lot of clout, given that you're the founder, chairman, and CEO. But given that, how do you empower board members to give you real and honest feedback on your initiatives? Because I could just, we imagine as outside shareholders, this view of the chairman as, dominating the conversation and, whatever the chairman says goes. But I think that's not helpful, and it helps to have a devil's advocate. So how do you foster that within the boardroom?
I certainly think that our lead director plays an active role in making sure that there is good discussions around strategy, for example, or decision making. This coming September, we'll be having our annual, 3-year strategic review, and holding us accountable, to look back and say, okay, what did we say we're going to do, and where are we? What are the items that are complete? What's ongoing? And so it's not just holding me accountable, but it's really holding the whole management team accountable for what the board has signed up for, whether it's the annual budget or that 3 to 5 year strategic plan. All the directors on the board, I had no, they're not friends of mine, right? So they're professionals that at one time or another were brought in for their expertise at the time that was needed, whether it was in finance or marketing or technology, and so we continue to look at the dynamics of the board, as well as look at where the company is in its growth, and try to figure out, okay, what's the next director going to look like? How do we challenge ourselves to make sure that we keep bringing on great talent at the board level as well as at the management level?
One topic that's really interesting to me is how industries evolve and change over time. And so I'm interested, you've probably seen a number of both regulatory changes and business model changes over your tenure at Clean Harbors. So what important ways has the collection and disposable industry changed over the last few decades? And how do you create an adaptable organization that can flow with that?
I think early on in let's say in the first 10 years of our existence, we were much more an emergency response company. It represented a lot of revenues of ours. And I would say that as the use of oil continues to be reduced, particularly as more and more natural gas is being used. Fuel oil particularly, and number six oil in general, has been significantly reduced, particularly in power generation. So we've seen a huge decline in the oil spill side of our business. Open 90 put in new regulations to force industry to do a better job of managing their oil terminals. So we got more involved in the maintenance of those oil terminals. So instead of dealing with the aftermath, we're going to upfront and trying to help our customers deal with the regulations of management of their terminals. Every 10 years, they have to be cleaned and inspected and repaired. So I would say that as regulations evolve, as the market has evolved, I think the company has been really doing a good job of evolving itself to meet those new changes. And it's one of the reasons why we get into the hazardous waste side of the business is that, we realized that back in the mid 80s, that the new regulations are going to really drive changes to how waste was going to be handled, both recycling as well as disposal. And that's what drove us to really expand in that side of the business.
Got it. That makes sense. And then, this has always been a company that's focused on, the environmental side, and safety is such a big part of having a good, kind of social sustainability aspect. But obviously ESG is a big topic these days. Have you had to shift the way the company practices or any of your policies to satisfy the desires of your different stakeholders? Or, is this stuff you've really been doing for decades and it's not really that new for you?
I'd like to think that we've been doing it for decades and we can always do better. We could do more. In regard to diversity and inclusion, for example, I'd always like to think that we were doing that all along, that that's our culture. But I know we can always do better around those areas as well. So I would say that, we just published our first ESG report. I think it was terrific, but it was just our first one, and it's a start. I think we've shown a tremendous amount of progress in what we're doing to improve in this area. But safety has always been the most important thing in how we run our company. We really think that is one of the top areas of any investor who's thinking about making an ESG kind of investment. Is this a good company? Are they good to their employees? Are they really safe? And are they really worried about the communities that they're operating in? All those things are really the checkbox that you can check for us.
Sticking on the governance side of that a little bit, it's something that's really important to us, and in your case, you have the combined chairman and CEO role, so that gives that is always a question mark in terms of corporate governance. I'm interested if you can think of any instances in your career where interactions with your shareholders have actually been really helpful as you were either considering corporate governance initiatives or capital allocation initiatives. Has that been the long-term relationships with shareholders, has that been helpful in any way?
Oh, absolutely. You always are interested in their advice and their opinions and their insights. I can't think of a time when anybody questioned my alignment to the company. I'm the largest inside shareholder. I've held my shares almost 42 years now, and my interests are aligned to all shareholders. They really are. And I think that the lead director certainly plays a critical role in the fact that I am chairman and CEO, but the lead director, runs the meetings when I'm not there, takes care of the executive sessions, runs the independent directors meetings. We have 4 great committees with, corporate governance and comp and EH&S and audit. I'm not participating in any of those. So, we have a very good, strong board and corporate governance structure here, I believe. And I think we're all aligned.
It's interesting you bring that up. It's something I hadn't really thought of, but I actually teach a class on corporate governance to UCLA undergrads every year, and I actually use you as an example because you, over a long period of time, have sold down some of your stake, right? Which makes sense, right? But people sometimes have this reaction, well, oh my goodness, the CEO is selling stock, there must be something wrong. And my point to the students is that if this person still has a meaningful stake, like that person is still aligned, and there may be other reasons for their selling. Maybe they've set up a foundation, right? You can't just say, "Oh no, the CEO is selling stock." Like that is an immediate, red flag.
Yes. Yeah, and I did set up a foundation, and there's been a number of interests that my family and I have had, particularly here in the greater Boston area, that we've been strong supporters of, and will continue to be strong supporters of. It's really, important for us to give back to the community, and substantial amount of what I've been doing with shares that I've been divested have been around my foundation, and I'll continue to do that, to be honest with you.
Yeah, I mean, it's why we focus so much on the motivations of people as opposed to just like, looking at a spreadsheet or looking at a share sale as something that is, that suggests that you're not aligned. So just a totally random topic that I don't think I've ever seen discussed. You guys have such a strong footprint in the US, and you mentioned the assets in Canada you acquired that, obviously was not timed particularly well. Is there any reason, or is there any way that international M&A would ever cross your radar, or is that the regulatory differences and where your expertise really lies? This is just like it's just like outside of your circle of competence to think about what some other waste collection business in another country.
So in the industrial side, the company had a number of what I would call either joint ventures or operations offshore that came particularly during the Eveready acquisition. There was a joint venture in China. There was one, I think, in Greece. There was a catalyst recycling company headquartered in the UK. And we divested all of them, and it was predominantly because we just didn't have scale. Safety-Kleen, on the other hand, had a large business based in the UK that serviced a lot of different countries over there, providing the exact same businesses they did here in the US. And they sold that when they were in bankruptcy. I mentioned back in 2000, 2002. Safety-Kleen Europe exists today and is a very strong brand in Europe, and it's private equity owned. A company like that might be a company that would be sort of the footprint that we would need to springboard from if we were able to put together a deal on something like that. But unless we had scale, unless we had size, we probably wouldn't just go over and open up an office. We really need facilities. Safety is so important. And, we were servicing a tremendous amount of refineries to do catalyst work at refineries all over the world. And we really didn't feel comfortable from a safety standpoint that we had, sort of the scale to do that. And that's why we sold out of that business back then. But I hope at some point there would be an opportunity, because the regulatory environment is pretty good there. And that's what we need more than anything. We need to have sort of a good framework of regulations that we can set up shop in. So I would say that, still plenty of room to grow here in the States and in Canada, but we're keeping our eyes open.
Yeah, I can imagine having a cohesive and consistent safety culture around the world would be really hard. And sticking on the safety thing, I mean, you mentioned that's part that, like, you want that to be your legacy, that you leave a company that was focused on safety. Any other things that you would like to leave with the company? Is it either cultural or, focus on free cash flow or ROIC? Anything that else that like whenever you decide that you want to pass the torch, like you want your successor and all of his or her reports to really have imprinted on their desk somewhere?
Yeah, I think it really gets into our core values around safety and about quality and how we treat people with respect and customer service, and how we want to make sure that, we have a reputation of being a top, service company to our customers. I think when we think about those core values that we try to instill, and every year we honor at least 100 employees for their excellence in a particular area around our core values. I think that would be something that I would love to see sustained, when I'm gone, and carried on, because I think, people are so proud of getting up on that stage every year and getting an award around safety, or around compliance, around quality customer service, or teamwork and communication. Those things sort of, we build on momentum always, and I'm pretty pretty pleased with the kind of company we are.
I mean, you've seen a lot of success. I think you said you started with 600,000 in revenue, a long time ago, and we're over 3 billion now. Any other elements of that success? I mean, you've talked a lot about culture. Any other disciplines or elements of that success that you would point out for, someone who's founding his or her own company and wants to embed that within their kind of view of the world?
Yeah, I would just, I guess what I would say is not letting our tentacles get too far extended. We probably reached further out than we should have in some areas to try to get more waste to come into our facilities. We worked, a deal to acquire a company that maybe had a landfill or maybe had a treatment plant, but it came with a lot of other things, and we said, oh, we'll take care of those things, we'll make them better. And so I think, really our focus, and to make sure that we don't spread ourselves into areas that are not part of really what our focus should be, I think is something that I think we've learned, and probably all of us here in the management team have seen, because sometimes markets change so quickly that, you get caught sometimes, and we've seen that happen a couple times here. I don't want to see that happen again.
And just sticking on the idea of capital allocation for a second, because you mentioned that ROIC has been such a big part of compensation and the way you measure yourself. We don't see many CEOs that have that North Star. We wish they did. That return on invested capital, like everything we should do, should have a higher return than our weighted average cost of capital. Where did that emanate from? Like, where did you develop that North Star?
I would say that one of our board members and one of our shareholders together really took issue with the lack of return on invested capital that we were generating here. And it wasn't simply that take this number from here and make it that, it was the continuous improvement expectation that they had, that we weren't building on it. Our ROIC has not always been where it is today. And I think that we weren't paying a close enough attention to it. We were certainly looking at our capital budget. We're looking at, sort of good use of good returns on our investment to replace equipment or expand equipment or plants. But overall, it wasn't at the level that it should have been. And I would say, with a couple of shareholders pounding their fist and one of our board members really taking issue with it, I think that we realized that we needed to change. And I think that's how it came about, to be honest with you.
Interesting. So another example where shareholders were helpful in your path.
Yeah.
So I think we're going to close with the question that I always ask our guests. I think we've talked a lot about the asset base of this company and things that maybe people don't appreciate. But what would you say are the most misunderstood or underappreciated aspects of your business that you would want to leave, anyone who is interested in this company to understand?
I think the repetitive nature of our revenue streams. I think that I think we have a bottoms-up approach to budgeting by account, by line of business, and I think that we have very, very good visibility into our revenue. And when you look at that, coupled with particularly the last 3 or 4 years, the continuous improvement quarter over quarter with our financial performance. We digested the Safety-Kleen acquisition. We had our challenges as a result of some market issues that we had to deal with, but we've really now got the business doing extremely well. That business generated about 150 million of EBITDA when we bought it. It probably went down to about 70. It's going to generate close to 300 million this year in EBITDA. And we see nothing but upside, to continue to kind of grow that business. So I think people, hopefully they'll continue to look at the success that we've had in integrating that acquisition and look at this next acquisition that we're making with HydroChem and realize that we really expect to do the same and really kind of drive those kind of margin improvements.
Yeah, well, it sure feels, as I mentioned, it feels like the machine is really running. And so we are looking forward to seeing, what HydroChem brings in terms of those opportunities. So Alan, this has been incredible, an incredible overview of how the industry has changed and, what you've learned. Thank you so much for the time. This has really been a really valuable conversation.
Great. Thanks so much for having me. I appreciate it.
That's it for our show today. We hope you enjoyed the conversation. We recognize that you have a lot of different podcast choices, and we appreciate you spending the time with us. We are continually working to make the show better, and we would love your feedback. The more candid and honest, the better. And if you have any suggestions for public company CEOs you would like to see on the podcast, please let us know. And of course, warm intros are always appreciated. Please feel free to email us at podcast@covestreetcapital.com with your comments or suggestions. Thanks again, and stay tuned for the next episode of Compounders, Anatomy of a Multibagger.